Warren Buffett's best advice. Who is Warren Buffett? Warren Buffett, in full name Warren Edward Buffett, is an American businessman and philanthropist born on August 30, 1930, in Omaha, Nebraska, United States. He is widely regarded as the most successful investor of the 20th and early 21st centuries, defying prevailing investment trends to amass a personal fortune of more than $100 billion. Son of late U.S. Rep. Howard Hammond Buffett, Warren Buffett was known as the Oracle of Omaha because of his investment selections. He studied with Benjamin Graham at the Columbia University School of Business after graduating from the University of Nebraska with B.S. in 1950 and M.S. in 1951 respectively. He strongly follows the Benjamin Graham School of Value Investing, in which he looks for securities whose prices are unjustifiably low based on their unique value. Buffett returned to Omaha in 1956, and in 1965, he acquired a controlling stake in textile maker Berkshire Hathaway, Inc., which he used as his principal investment vehicle. The major stock averages climbed approximately 11% each year from the 1960s through the 1990s, whereas Berkshire Hathaway's publicly listed shares rose nearly 28%. Buffett said in June 2006 that he would contribute more than 80% of his money to philanthropic charities. By 2020, he had increased this to 99%. The Bill and Melinda Gates Foundation, founded by Microsoft founder Bill Gates and his then-wife Melinda, aims to address global health and education challenges. Bill and Buffett had been friends since the early 1990s. Buffett's 3 children and the Susan Thompson Buffett Foundation, which focused on women's reproductive rights and financed college scholarship programs, were among the other groups that received the money. Buffett and Gates launched the Giving Pledge in 2010, an invitation to other rich people. Buffett executed several agreements during the subprime mortgage crisis of 2007 to 2008 that were enormously profitable despite being questioned at the time. In September 2008, he invested $5 billion in Goldman Sachs Group, Inc., a New York-based financial holding firm, and the following month, Berkshire Hathaway acquired $3 billion in GE preferred shares. Buffett announced in November 2009 that Berkshire Hathaway was buying the railroad corporation Burlington Northern Santa Fe Corporation for $26 billion. The investing firm already owned around 23% of the railroad. Berkshire Hathaway also owned large stakes in firms it did not control, such as Coca-Cola and Apple. Buffett is one of the world's most successful and respected investors at this time, and his investment advice is said to be timeless by a lot of investors. Today, we will be talking about some of Buffett's best investing tips. But before we continue, go ahead and click the subscribe and like buttons. It takes a lot to make these videos. Your small actions tell YouTube to keep promoting our videos. Also, tell us in the comment section what your thoughts are about Warren Buffett. Thanks. Now back to the video. Let's get right to it. 1. Investing is not rocket science, but there is no easy button. You do not need to be a rocket scientist. Investing is not a game where the guy with 160 IQ beats the guy with 130 IQ. One of the most common misunderstandings about investing is that only experienced investors can correctly choose stocks. On the other hand, raw intelligence is likely one of the minor reliable indicators of investment success. It does not take a genius to follow Warren Buffett's financial theory, but consistently beating the market and avoiding behavioral pitfalls is quite challenging. Investors must also remember that no magic set of rules, formulas, or an easy button can produce market-beating outcomes. It does not and will not exist. What Buffett is trying to say is that trading and investing do not need a high level of intelligence to be done smartly. Investing has nothing to do with the trader's level of intelligence, but with how they play the game. 2. The best moves are usually boring. We do not attempt to pick the few winners that will emerge from an ocean of unproven enterprises. We are not smart enough to do that, and we know it. Investing in the stock market is not a quick way to become wealthy. If anything, I believe the stock market is best suited to gradually increasing our current capital over time. Investment is not supposed to be entertaining, and dividend growth investing is especially cautious. Investing in firms that have previously established their worth is frequently preferable to identifying the next big winner in a growing market. After all, the idea is to identify high-quality firms that will appreciate over time. Our portfolio's return will take care of itself if we do this right. Many enterprises with lengthy and successful corporate histories provide snacks, drinks, toothpaste, medication, convenience shops, and other essential items and services. There is no need to impress someone with our investments or strive to be a hero. Boring may be attractive. 3. Know the difference between price and value. Price is what you pay. Value is what you get. Stock prices are constantly pushed upon us. Investors have a strange obsession with ticker quotations that scroll across the screen. On the other hand, stock prices are more volatile than underlying business fundamentals in most cases. In other words, there are times in the market when stock prices have little association with a company's longer-term prospects. Many bargains were available during the financial crisis because investors were ready to sell all firms, regardless of their company viability or long-term earnings potential. During the downturn, several businesses continued to develop their competitive advantages, emerging from the crisis with even brighter prospects. To put it another way, a corporation's stock price was, temporarily, detached from its underlying business value. 4. When you buy a stock, plan to hold it forever. If you are not thinking about owning a stock for 10 years, do not even think about owning it for 10 minutes. How long should a high-quality firm be retained once it has been bought at a reasonable price? Warren Buffett believes in the buy and hold strategy. Some of his roles have been with him for decades. Why? Because it is challenging to locate exceptional enterprises with a promising long-term future. Buffett runs a concentrated portfolio. Quality businesses also yield significant returns and grow in value over time. Time is the friend of the excellent business, as Warren Buffett observed. Fundamentals might take years to affect a stock's price, so only the most patient investors benefit. When Buffett is asked why he invests in a company, he simply answers, "Because I think it will be worth more in 10 years." Finally, investment returns are harmed by trading activity. Taxes and trading commissions chip away at returns when you constantly buy and sell stocks. Instead, we are better off buying properly and sitting tight. 5. Invest in what you know and nothing more. Never invest in a business you cannot understand. Getting involved in too complex investments is one of the quickest ways to make an unnecessary error. Many of us have spent our whole professional lives working in only a few distinct sectors. We presumably understand how these marketplaces function and who the most significant firms in the field are. The vast majority of publicly listed corporations, on the other hand, operate in industries in which we have little or no first-hand expertise. 6. Be rational. Rule No. 1. Never lose money. Rule No. 2. Never forget rule number 1. This is one of the most popular quotes by Warren Buffett. He doesn't believe in formats and formulas when it comes to wealth creation because he believes in investing smartly. Capital preservation should be the main priority of investors when deciding where to place their money in the market. The market fluctuates uncontrollably on a day-to-day basis because it is influenced by many positive and negative factors. So when something goes wrong and you realize it, it's better to simply limit your losses and get out of the position as soon as possible. When it comes to investing, we often make it harder than it needs to be. Warren Buffett follows a simple approach rooted in common sense. By taking Buffett's advice into mind, we can better manage our portfolios to reduce the number of errors we make to continuously move closer to achieving our investing goals.